Robert, good to have you back again.
Nice to be here.
Why don't you once more just quickly explain your investment philosophy, what you call Contrarian Investigator, and then we'll take it from there.
Well, delighted to. So I call myself, our firm, a Contrarian Investigator, because we like to look at situations where the consensus view is either negative or indifferent or downright hostile, with the idea that that's the area where we're most likely to find opportunities to make money over a period of time. We have the strong conviction that it's hard to make money in the consensus. The consensus is very often right,
but it's priced in.
But it's priced in. So we're looking where the consensus isn't, and that's where we start our investigations. But just because the consensus is negative doesn't mean that it's a good investment opportunity. So you use that to narrow the universe down, but then you start to work on whether there's value there, whether there's potential there, and how long it takes for that to come out over a period of time. So that's why we use this nomenclature, and I think it's more accurate to say that than to say that we're pure value investors, because while we look for value and we are value investors, our starting point is really on the contrarian side.
Now, what are some of the metrics you use? You like screens, but you don't like screens.
Yeah, well, I don't use screens. Many of our analysts do, so I'm able to say that I don't use them, even though some of the ideas that I probably look at come out of screens. But I'm convinced that a uniform metric doesn't work. I think you have to, part of the art of the business of investing is to...
Is that the operative word, art?
Yeah, I think it is. It's much more art than a science, and it's much easier than science. I mean, I've said this many times, but there's a reason why the expression is it's not rocket science, as opposed to saying it's not portfolio management when you discuss things that are really hard. Because rocket science and brain surgery is difficult, but portfolio management, I think there's a great deal of common sense associated with that, and you don't need to be a mathematical genius to do it. Part of the art form is to select the metric that is the most important in each given investment situation, and it's not always the same. And that's
a quick example of that.
Well, a stock like Microsoft, which is a stock that we own. Now, almost all the metrics there are good, right? So you've got great free cash flow, and you've got very high margins, you've got very high returns on equity, right? And you've got a relatively low price earnings ratio. So you probably have a very high ratio of price to book. So, what metric makes the most sense in looking at a stock like that? I think in that case, for us, the metric that makes the most sense is market share. Right, that gives a sense to us of what the moat is for that company and why it's likely to be able to continue to generate these other attractive numbers and these other metrics. So it's different for different stocks, and that's the way you make your investment decision. I think you see if the metric that emerges as being the most important one from your point of view is the one that can carry the investment thesis over the next 3 or 4 or 5 years, which is how long we tend to own stocks.
Now, you make the point that you try to look at a business as if you were going to own it rather than having paper shares in it.
Right.
And that gives you a different perspective in terms of sticking with the stock.
Well, I think that's what you should do. I mean, if you look back at the history of investing, it didn't start recently. People have been investing for a long period of time, and sort of the great advantage of owning shares is liquidity. And that is a big advantage, but taking that advantage aside, what you really want to do when you make an investment is make an investment in a business. And you don't make an investment in a business, generally speaking, for 3 months or 6 months or a year. You make an investment in a business for what you see as at least a business cycle, if not longer. If I were a mogul and owned hotels and restaurants and a magazine company and real estate and all the rest, I wouldn't say, well, the outlook for the next 6 months isn't so good. I think I'm going to sell my magazine company. That's not the way you do it. You take a longer-term perspective, and that's the way I think you make money and accumulate wealth over time. So that's the way we look at it as well.
You once said that if you're not willing to hold, or if you're an investor, you're not willing to stick with something for 3 or 4 years, you're a gambler. Could you explain that?
Portfolio management is not that hard, but you can't it's not that easy either. And to think that you can make superior decisions over a relatively short period of time based on what you think the world is going to do is, I think, pretty difficult. And it's like betting on a horse, right? So whereas I think it is possible to make reasoned, you might be wrong from time to time. Your batting average might not be as high as Derek Jeter's, but it's easier to make a long-term bet when you look at the strengths of a company and how you expect things to unfold than it is to say what's going to happen in the next 6 months. I just think it's more predictable. And as a consequence, if you're doing things with this very short-term orientation in mind, there's a lot of variables that could affect your decision, and as a result, I think it's more speculative, and so we don't do it.
Quickly explain how, with mid and especially small cap stocks, you get your contrariness. Big ones are easy.
Yes, big ones are easy, and as a result, at least in the corner of the business where I'm managing the money, we have about, I don't know, $14 billion under management. I manage a portion of that. We've got a big gold product, and other things are managed in different ways. But in my case, I tend to have more large cap names because it's a lot easier to find things that are out of favor and contrary that are large cap. But we also buy mid cap and small cap names, and there it's not so much a factor of pure negativity as it is sort of investor ennui or indifference or lack of enthusiasm altogether. So you find the smaller the capitalization, the more likely that you're looking at names which are just ignored and haven't been followed or written up or...
So how do you get a list of choices?
Well, some of that probably is screening. I think some of that, and also we have, we've got, I guess, about 30 professionals at the firm with, I don't know how many thousand years of experience between them. And so we all have a universe of names that we've looked at over the years and return to from time to time to see how things are going. But it is very eclectic and episodic. It's hard to have a real process for finding those kinds of names. They come out of the ether.
Now, you once said underperformance can be a badge, a sign of discipline, that you don't let the emotions sway you.
Yeah,
You've had a little bit of underperformance recently.
Yeah.
Why is it a badge of honor?
Well, first it's a red badge of honor, but well, I think that and there was one other period in my career where we underperformed far more significantly than we do right now. Yeah, the late '90s. And there it was pretty obvious, we didn't want to participate in the internet boom. We didn't understand it. We didn't understand the technology, and we decided to stick to our knitting. And it cost us from a performance point of view, but it led to a really superior performance over the next 7 or 8 years. This go around, I think that there are two major reasons why we've lagged somewhat, although the lagging isn't that much. But one is we didn't own Apple, right? And Apple is so big and such an important part of the market-weighted indices that has a big impact. If you don't own it, it hurts you.
Well, and that can go down too.
Yes. Well, and I'm going to talk about that in just a second. But and then the second is that we cannot bring ourselves to buy the big financial names, the big money center banks, et cetera, because the whole world has changed as far as I'm concerned with those names. They're no longer really companies. They're adjuncts of the government. They don't operate the way a private sector capitalistic company operates because they've got the government sitting on them, and I don't know how to analyze that. So I do think there's trading opportunities in these things, and they have moved from time to time, and when they move, it hurts us because we don't own them. But I'm not going to own them. I mean, I don't know how to analyze them. So, that's just a risk I'll take.
You also make it a point, you never let a position go more than 4 or 5% of the portfolio.
Right. Yeah. Well, I mean, there are times when I wish that I would have, but I'm afraid. To me, managing money, particularly for wealthy individuals, which is what I do the most, it's all about preserving wealth, right? So, if you own a really large position in your portfolio that is outsized compared with everything else that you own, that whether you know it or not, even if you love the company, you're taking on a lot of risk. And I've been in situations where I've seen really high quality. I like the Merck example is my favorite example, because Merck was flying very high and everybody loved it. And I think it might have even been the highest capitalization stock on in the S&P 500 at one point. And one day they came out and said, you know, Vioxx creates heart problems, and the stock got cut in half. Now, you'd have never expected a stock like that to get cut in half at the time. And the danger of owning a significantly large or overweight position, in my view, is that you never know what can happen. There's a lot of uncertainty. So I'm more comfortable with smaller positions and a few more names, but we're still terribly concentrated by comparison to most places. We have 50, 60, 70 names in the portfolio, but we're not going to own one name that is 5, 6, 7, 8%, because there's too much risk in it if things, and you can't foresee everything. So
now, in the case of Apple, obviously there's a lot of love out there for Apple.
Right.
When you look at the financials, they're not that out of line.
No, I think that's a very good point. That's a terrific point, and that's one of the conundrums, is that from a valuation perspective, it's not expensive. So all the more reason why, you didn't know, if you're so smart, Kleinschmidt, why don't you own Apple? Well, I think the answer is that the sentiment, the overall sentiment, and again, it's partly subjective, but the overall sentiment was that this was an infallible company. There wasn't anything that they could do wrong from a product point of view. And I saw it everywhere. And so it seemed to me that regardless of the valuation, there was enthusiasm built into the price of that stock. And for those of us who are old enough to remember, in a way it struck me, it reminded me a little bit of what Sony used to be like in the 80s, where every product that Sony made, the Walkman and the TV and everything they made, they were fantastic. And now Sony's just another company, right? So I felt that the possibility that Apple would stumble and cause a big decline in the price of the stock was just too great of a risk to take. Now, I had been wrong. I'm a little more right recently, because the stock's down 100 points or so since the latest iPhone came out. So, and maybe it'll get cheap enough where we'll take a look at it. But I'd rather own Microsoft, which is sort of the opposite of Apple. It's just as cheap from a valuation perspective. But as far as most people are concerned, Microsoft can't do anything right. There's no enthusiasm for Microsoft. And they got stuff coming out that might work and might have it. But any of the surprises for Microsoft are going to be on the upside, whereas the surprises for Apple, strikes me, were more, the potential was that the surprises would be on the downside.
So if, take Microsoft, if you took the name off of Microsoft and just look at the financials, anyone would say,
fantastic.
Yeah.
Big market share in the enterprise, overwhelming market share in the enterprise. Big market share in the home with Xbox, which is becoming kind of it's more than a game console, and I think they're ahead of everybody on that. They've got a brand new software coming out within the next few days or so, where there's some enthusiasm, but not much. It's just, Microsoft is just sort of like the red-headed stepchild, but if they surprise, I think there's a lot of upsides in the stock. So. And I don't think there's much downside, which is really important to us. We don't like to buy things where we think we can lose a lot of money.
You're a bit gloomy on the global economic situation. You still like equities. Give us a quick summary why you're gloomy on the global situation and why you'd still be in equities. And then answer the question, the market's done fairly well.
Right.
Who's buying? Certainly not the individual.
No, that's true. That's true. Well, first of all, it's hard to give you a short synopsis of why I'm gloomy on the
Spain,
global economy. Well, I think that all of the developed world is in debt way over their heads, and that there are very few things that you can say with certainty, but one of them that you can say is that they will never pay back their debts. Never. Now, so that means that all of them, one way or another, will default. Now, how will they default? Will they default like Argentina? Or will they inflate their problems away? Well, my guess is that politicians being politicians, they will try to inflate them away. Now, what's happened, and it's been the best of all possible worlds for a lot of these countries, although it's coming home to roost for Spain and Greece and Italy and others, but But for the United States and Japan, for example, interest rates are so low that they're kind of in the interregnum period between either a default or an immediate default or a gradual default through inflation. And so what they've been able to do is, borrow money at nothing and spend it, and in other words, buy votes with other people's money for no real cost to them. So what those of us who looked at this closely believe, and I certainly believe, is that this is a problem that will be solved not by politicians, but by the bond market. And I can't tell you when, but one of these days the bond market will say, you know what, 2% isn't enough for a 30-year piece of paper, or 3% isn't enough for a 30-year piece of paper. I need 6%. I need 7%. Otherwise, and when that happens, the whole house of cards collapses. And that's that's a very unhappy situation. So that rules out bonds, right? You can't own bonds. You can own some real assets, and we do. But the only financial assets that you can own sort of by default are equities, because at least equities have the ability to keep pace with the inflation that we see. And the other thing about equities that's attractive is that corporate balance sheets are very solid. If they're not going to be in the same situation that governments are, that when interest rates go up, they have to go out of business. So it's not a wonderful scenario, but by default, you can't hold it in cash because your cash is going to become increasingly less valuable as prices go up. Can't own it in bonds because there's a terrible risk if interest rates go up, and they will eventually. You can own some real assets, but residential real estate was way overpriced, and it's now sort of coming back to the point where maybe that's interesting. But timberlands, we own some of that, and clearly clearly gold is something that we talk about a lot, and we have a big position in. And I can't tell you whether gold will go up or down from here, because I can't tell you what gold has been discounting these past 10 years or so.
Let's discuss gold, because you have a gold fund.
Right.
And the gold price obviously has gone way up in the past 10 years. And yet, why are the expenses of the mining going up?
A
correlate question to that, why are the stocks lagging the metal, or is that changing?
No, it's beginning to change this past year, but they have lagged the metal for a long time. Well, what we like to tell people is that a good proxy for a gold company's revenues is the price of gold, but a good proxy for gold companies' expenses is the price of oil. Not exactly, but it's pretty close. And so what's happened is that you've had, gold lagged oil over the past 3 or 4 or 5 years or so. So expenses in the mining industry have gone up. So that's point number one. Point number two is that the managements in the mining industry have not been the strongest. For the last many years or so, the best and brightest wanted to go down to Wall Street, right? The best and brightest didn't say, geez, I want to go into the mining industry. So I don't know if the managements have deployed their capital. As a matter of fact, I'm rather sure they haven't deployed their capital intelligently, and they've overexpanded in places where grades are poor. They've been in a lot of countries where the political risks are high. And what you find in raw materials in particular is that once the prices start to go up, the governments start to nationalize. They want more, right? They're perfectly happy to have you come in and develop the mine when prices are low. But the minute prices are high, all of a sudden you're stealing the national treasure. So that's a difficulty for a lot of these companies as well. So it's a leveraged way to play on gold to buy the mining companies. But I think a lot of people see it as a safer thing just to buy the metal itself. But let's get back to the metal. Gold has gone from $200 to $1,700 an ounce over the last 12, 13 years or so. It had to be discounting something. The one thing we know is that markets discount the future. It doesn't discount the past. So how much into the future, I don't know. Maybe this 1,700 has discounted sort of the financial collapse of the Western world that I've been talking about. So maybe gold doesn't have a lot of upside from here. But I can't gauge that. But what I can tell you is that over long periods of time, an ounce of gold, you've been able to buy a pretty good suit at Brooks Brothers with an ounce of gold. And my guess is that 50 years from now, you'll still be able to buy a pretty good suit at Brooks Brothers with an ounce of gold. So it does preserve your wealth. And so some percentage of your wealth should be in that.